Go back and watch some of my previous videos about Crocs stock, ticker symbol CROX, and how this has been one of my big winners in 2022. If we look at my holdings tab, you can see that it currently makes up about 20% of my invested net worth in my growth portfolio, and I ended up buying this company at $76 a share. And the fact that it's already at nearly $100 in such a short time period of only about a month or two, it's been doing very well. And this has mostly been off of the back of its earnings, with this company going up big time. If you didn't know, this quarterly report was awesome. In the most recent quarter, they grew 57% year over year. A year ago, in the last quarter that they reported these type of numbers, they put up $625 million in revenue. This quarter, they put up almost $1 billion, over 50% growth year over year, and the direct comments from the company said, quote, "Our exceptional third quarter results, including record revenue and industry-leading adjusted operating margin of 28%, are a testament to the strength of the Crocs and Hey Dudes brands. We are raising 2022 guidance following our strong back-to-school performance and 20% constant currency revenue growth in the Crocs brand. We are confident in our ability to continue to gain significant market share, deliver best-in-class profitability, and generate strong cash flow." That's directly from Andrew, the CEO. Now, that was in the most recent quarter, and since then, like I mentioned, the stock price has been rewarded. If we look at this over the last year, you can see finally when we start to see an uptrend is when they reported these numbers, when it was $67 a share. Fast forward a couple weeks after that, the stock broke 100. And if you look over the last month since they reported this, it's generally been trending up about 29% over the last month, and it seems like there's no end in stop. Now, this leads me to where I'm at. With my portfolio currently sitting at $40,000, that looks great, but I've invested heavy. And I mean, I am honestly a lot more indebted in my portfolio than I want to be, and I'm pretty highly levered. And so this begs the question, is now an opportunity for me to cash in on this liquidity event with this company reaching about $100 in share price? Will I be selling some or all of my stake in the company, or I'm going to be holding out until the next few quarters, until next year, as this company continues to grow? Well, that's what we're going to answer in this video. So if you want to see Crocs brand, if you want to see Hey Dudes, if you want to see how this company is growing and what I plan on doing in 2022, moving into 2023, this is the video for you. We're going to talk about the company's revenue growth. We're going to talk about their international footprint. We're going to talk about their revenue growth versus constant currency on an international basis. We're going to talk about the revenue split between the Crocs and Hey Dudes brand and how that affects the company. We're going to talk about how Hey Dude has basically beat expectations across the board, not only by the company that they bought out, Hey Dude themselves, but Crocs' internal projections, beating about a year expectations from the time they had revenue targets. We're going to talk about debt leverage, how they're using their free cash flow to pay off their debt, which we will model out in Qualtrum like we always do, as this company does have a highly levered balance sheet and they're slowly working on paying it off. We're going to talk about valuation, stock price, everything Crocs. So if you want to see it, this is the video for you. Thank you for tuning in. Get signed up with M1 Finance if you haven't already. If you want to see my portfolio, how I invest this $40,000, the holdings I have, and the performance since starting the year of 2022. So thank you guys for tuning in. And without further ado, let's go ahead and do a flashback into yesterday's video where I talked about the year-over-year growth for a lot of the big shopping trends going on right now. So for example, one of my major investments, which is slightly larger than Crocs, Amazon, had a huge Prime Day, and they reported record number year over year, but that doesn't affect where we're at now in the current quarter. This takes us to Black Friday. You can see that this year's Black Friday, this is not just Amazon, this is not just Crocs, this is just a Black Friday search term on Google in general, is basically less than half where we were last year. Last year was 100, today is at 44. So that's pretty depressing. Now, Hey Dudes, let's go ahead and refresh this chart. It's constantly updating because I'm filming this right after Black Friday is over. You can see it, the search trend last year was at 100. This year is at 82. That's a bit concerning. Now, there's a lot that goes into this. There's a lot more than just Google search trends, so I do not want to take this at face value. There's a lot more to look into. But however, the fact that this is lower than last year's record is a bit concerning to me. And the same thing can be said for Crocs. Let's go ahead and update this chart. You can see that it currently sits at 78 versus last year's 99 and 100 during the peak holiday season. So that is a bit concerning to me. Now, I know that Crocs generally is popular more so during the summer rather than the winter, so I do want to keep that in mind. However, especially for Hey Dude, that's what I'm really looking at. It's good that it's gained traction here in the fourth quarter and getting back up to the 50, 60, 70s, and even now reaching 80 range. But considering that it's Black Friday, I would consider this to be at the new record 100 level, so that's a bit depressing there, especially with the research that just came out via Piper Sandler. Now, I'm not going to read over all this because this goes over an array of brands, and it would take me a million years to read through all of it. So if you want to pause the video and look at any of it, you can go ahead and do so. But I highlighted in the big letters in red, as you can probably see, it says that Crocs increased from the number 6 preferred footwear brand to number 5, while Hey Dude is now ranked number 7 from previous number 9. So not only did Crocs go from number 6 to number 5, it went up 1. Hey Dude also went up from number 9 to number 7, and this is in the teen survey from Piper Sandler, and this is a third-party resource. This is not directly from Crocs. This is a very legit publication that comes out every 6 months on a semi-annual basis, and I love reading this because it gives you all types of insight to different brands and different trends, especially for young people that are typically in the 10s or teens or early 20s age, so like around mine, if not a little bit younger. So that's really cool to see. Now this company, as I did read this, they did increase their guidance year over year, and that's really what led the stock price to skyrocketing year over year. It is doing very well since I have bought in at around the $76 range just 2 or 3 months ago. We're now breaking around $100 a share. Now this company is growing, and the main source of growth is really from Hey Dudes. You see that the Crocs brand grew 14% year over year to $716 million. $269 million was put up for Hey Dude, but that was coming in at an 87% revenue growth. 87% is incredible. Now the coolest part of all this is that when you look at the growth of Crocs, it is not really in North America, it's not in the United States, it's really coming from the international segment, and this really brings up long-term opportunity when you look at this on a constant currency basis. So in the Asian Pacific region, it grew 66%. Which is incredible. If this was on a constant currency, it would actually have grown 82%. Now for the EMEALA, it grew 26%, and it would have been 46% on a constant currency. By the way, those of you that are watching that are thinking constant currency, what does that mean? That means as the price of the dollar rises in value, it makes foreign currencies less valuable. So for example, if the dollar goes up a ton in value, and say if we sell one of these pair of shoes in Mexico, and the Mexican peso falls in value like it has, then a dollar brought in a revenue of Mexican pesos is not as valuable it was before the currency change price. So that's all we're looking at here. So if the dollar were to fall, that would improve these numbers. If the dollar rises, it hurts these numbers. And so actually, if there wasn't currency issues, you would have seen 80 and 46% growth. And that's not something Crocs can control. So that's really cool to see. Now looking at the revenue split here, you see that $2.6 billion roughly is what's projected for Crocs on a constant currency basis. That would be 17% growth. And if you look at Hey Dude's revenue, it gets almost all of its revenue domestically here in the US. It is projected to be around 850 to 900 million in revenue, which is starting to make up a pretty good chunk, now reaching at about roughly a third of its revenue, slightly under a third, and I think it's going to quickly outpace that of Crocs because it's growing so much faster. And you can see earnings per share is projected to finish out around $10 or so. And considering today, if you do some quick math, this is super simple, right now we're at $95 a share. And we're projected to have $10 of EPS this year. What's 95 divided by 10? Well, that means the PE ratio of this company right now is about a 9.5. Last time I checked in the market, I believe the average right now we're at is somewhere around a 17, I believe. So that means that this company is trading not much higher than half of that in the average on the stock market. So that's pretty darn low. And this leads me to not only this company having a low valuation, but this company beating its own expectations. I don't want to read all of this. What I really want to focus on are these two tabs right here. Initial expectation of achieving revenues of $1 billion was expected in 2024. 2 years later. Now, they're expecting revenues to be over $1 billion in 2023. They're moving their $1 billion revenue target a full 12 months earlier, meaning that this is far and away exceeding their expectations, and to be honest, it's exceeded mine. Now, they posted this about a year ago when they did acquire this company, and they wrote that they are wanting to do no share repurchases in 2022 until gross leverage is less than 2x. Gross leverage meaning basically their gross debt divided by their adjusted EBITDA, and you can see how it's skyrocketed from this initial acquisition plan of 3.1x and how they're lowering over time to get it to less than 2. They're doing that so far, and they have reiterated this in the most recent quarter, so that's good to see. And you can see this in real time because if you look at their free cash flow, the most recent quarter they put up about 130 million in free cash flow. Now, if you look at their 130 million, you can compare that to the debt. The debt lowered about 150 million. So they used pretty much all their free cash flow plus a tiny bit of their cash on hand, which is why it went down. Basically, every dime of profit that this company is getting, it is putting it back into paying off this debt, which is exactly what I want to see. Because the reason this company is valued so low in terms of its PE ratio, why investors are not willing to pay so much for it, is because of this company's leverage, because of their debt. When you look at this revenue growth, you're thinking, wow, this is fantastic revenue growth. This company should be trading all-time highs. And when you look at this over the last 5 years, you can see that the all-time high is actually around 180, and today we trade at 95, which is almost 50% lower than where we were at an all-time high at almost exactly a year ago. So when you see this high record revenue, you're thinking, okay, they're putting up record revenue. They're putting up lots of profits. Why is this stock not trading at its all-time high at around 180 up here? Well, that leads me to the balance sheet. Just like we mentioned just a second ago with the debt, you can see when this debt skyrocketed from the deal earlier this year when they raised $2.8 billion in long-term debt, and you can see each quarter they paid off over $100 million each and every quarter, and they're getting through this mighty quick. On their projections, they are saying that they're going to have the less than 2x leverage by mid-year 2023. So when we're having this conversation somewhere around 6, 8, 9 months from now, I think that this is going to be around what they're projecting, which is that less than 2x leverage. So I think it's going to be very likely that when they report their second or third quarter earnings of 2023, this $2.5 billion worth of long-term debt is likely going to be somewhere down by this little tick right here, probably somewhere around 2x. Not to mention the cash is staying steady because they're using all their cash flows. And the cool part is that when we pull up share-based compensation, see the blue number right here? They hardly pay out any of their free cash flow in share-based compensation, which is why you can see quarter over quarter, they're barely diluting us at all. It barely even trickled up because this company hardly pays out any stock. So the thing is, this leads me to where I'm at today. Am I going to be selling the stock, buying the stock, selling part of it, investing more? Basically, this leads me to where I'm at today. With my portfolio, I'm highly levered. I am investing a lot more than I ever thought I would be in 2022. Just to be honest, on margin, because I am taking advantage of these opportunities in stocks that have dropped. And this may be an opportunity to me begin selling my shares. When I purchased these at 76, now we're trading at 95. Just the other day, we were at 100 plus. So this may be the opportunity for me to start to sell my shares. And where I'm going to start to sell my holdings in Crocs is around 115. Because if you look at this, if we put up $10 EPS, that would be around 11.5 in PE ratio. And I will say that this company does deserve to be trading lower than that at the average market, but even today at a 9.5, that's just too low. If we reach an 11.5, that's getting up there. More importantly, I'd have a lot of profits to book, and I could really use that to invest in my other companies that are still down a lot in value, like Google, like Amazon, like Salesforce, so I'd use that capital to invest in other opportunities. Overall, it's a company that's still growing. I am a bit concerned by these Black Friday numbers, but I'm not going to let that invest my decision of investing in the company. But overall, guys, stay tuned. I'll show you guys what I'm doing along the way. But in the meantime, thank you for tuning in. Thank you for watching all the way to the end. Check out all the stuff down below in the description, including $10 for getting signed up with One Finance. But other than that, guys, thank you so much for watching, and I'll catch you guys next time.